Hey, good morning, everyone. Marty Missouri here. It's Friday the 3rd of March, 2023 with your end of week market snapshot. Clients, this will also be our morning message. Got a lot on our calendar, or a lot on our to-do list today. Of course, the weekly economic update, and we're just past February, so it's time to score our monthly equity market conditions index, and that one takes a while. So I just thought I'd jump in super quick, give you the technical look at the market, and then get to work on the other items. Probably get the economic update today, if not over the weekend, of course. And then the commentary on equity market conditions will probably be Monday morning's written note. Wanted to take just a quick look today at the S&P and then at the VIX. Before I jump into drawing lines here, just a quick commentary on the Fed. So pretty good sell-off, at least in the S&P and the NASDAQ. Not huge, but people felt it on Wednesday. And that coincided with some pretty aggressive commentary from Minneapolis Fed President Neel Kashkari. And he essentially said what he's been saying. Not these words, but market's getting it wrong. And he actually said, we don't want to make a lot of dovish comments because that's going to put markets in rally mode. It's going to counter the wealth destruction effect that Fed policy is having. And it's just going to be counterproductive. We're just going to have to keep doing what we're doing for longer if markets continue to hold up here. And market hated that comment, of course, or that commentary. And the very next day, Atlanta Fed President Raphael Bostic came out and just absolutely said something dovish. He even said, hey, we may be able to pause by the summer. And I'm all for a 25 basis point hike next month, and they've been talking about 50. So he just did exactly what Kashkari said we shouldn't do. And the market absolutely loved that yesterday. On that news, options action. I've talked a lot about these zero data expiration options. We have experts in that industry who we use to give us color on that. They said that was just a flip. It was very unexpected. The market wasn't positioned for it. Came rushing in. It's happening again this morning. So the market is still kind of buoyed, looks like, from the likes of those comments. I'm not saying that's all of it, but it certainly didn't hurt what Raphael Bostic had to say. Now this morning, in fact, in about 8 minutes, we're going to get the ISM services survey results, and earlier in the week when we got the manufacturing results, which were actually headline down, but the prices paid index was up above 50, and that freaked the market out a little bit. So there's going to be that kind of inflation data in the services survey as well. So we'll see. The market's trading up nicely this morning. S&P's up, gosh, almost 2/3%. So apparently there's a lot of confidence. Maybe someone else is speaking this morning and I've missed it from the Fed, and they're helping things out. So we'll see. There is this options flow, folks, that is having a not small impact on the daily moves in the market that we have to be careful, because that's noise and we could mistake that for signal. It does have some technical relevance for sure, but fundamentally speaking, we have to be on our toes. And we need to understand what's happening there. So recall that when we did this on Wednesday, I said I wasn't really feeling it when I said that the market may break down below something technical that would precipitate a drop to what I think is likely the really good stopping point here for a while, and that's 3,800. Our base case is that if we do have recession, which is our base case, corporate earnings are going to reflect that, and we're going to go well below 3,800 before this is all over. But that doesn't have to happen right now. So remember, we broke out of this what turned out to be a falling wedge pattern against bullish divergences. Gave that up pretty quickly, right? But remember I said that we were up in here when we did that video, that we could come down here and we would still have notable bullish divergences. That's exactly what happened. And here we are popping up off of that level, as you can see, and kind of testing this line right in here at just above 4,000 on the S&P. So this not bad pattern in here looks like consolidation beginning right in here, but this would suggest that we could break to the upside. Our options experts this morning are saying that we've got this range between 40.50, which would be right here, and 39.50. They think that'll be contained, and that 4,000 is probably going to be the magnet for the market today. So, 1% move above or below that. You break above 40.50, and that internal options action is going to force, some upside hedging and some buying into this, and that could actually inspire something more meaningful to the upside, at least for the short term. And remember the other day, a marginal new high on some momentum would not be the least bit out of the question, and we'd still be operating within the context of an ongoing bear market. Or a break below 39.50, and I think you get that with some momentum, and suddenly 3,800 is in play. So they think that if you can break out over the next few days in one direction or the other, that may carry the trend into options expiration, which is going to be a big one on March 17th. So we'll see. Next week, March 10th, we have the jobs number, and that could certainly be a needle mover for equities. Quick look at the one-year daily chart, and I'm going to ask your forgiveness while this is loading because it's getting too busy here. I'll work on it. You still have, a not great look. Coming a little bit up here with yesterday's move on the RSI, consistent with price. Still have a sell signal, although we're losing some downside momentum here, obviously, on the MACD. Let me clear off the momentum indicators. Might make this a little easier to look at. So, as you can see yesterday, we couldn't quite overcome again or come back above the 50-day moving average. That little speck right there is today, though. So today we've gapped above the 50-day moving average. And I did go ahead and draw these flags here, and they've been pretty good patterns for us. You sell off, and these are bear flags. It goes the opposite in bull flags. You sell off, you consolidate kind of in an upward slope back toward where you were, and then you break down below, and it's about the length of the flagpole is what you're looking for. So that one would have stopped right there, but it did keep going here. And so then we started to flag back up in this other direction. So the length of that flagpole actually takes us right down to what I would say would be a short-term target if we break down, which would be 3,800. Right now we're dancing right on that, and I don't need to draw it again, but that's right at that 38% retracement line that we talked about last time. So the market's trying to battle through some resistance. This is pretty strong support right here. The blue line is the 200-day moving average. The red line is the bear market trend line. You can see it did bounce off that support, which keeps the inverse head and shoulders pattern that I've drawn 10 times for you still in play. So we'll see. Our base case, longer term, right? But open to all possibilities. So the technicals are somewhat ambiguous here, but it wouldn't surprise me in either direction right now. Maybe the bulls have the edge in the very short term. And lastly, really quick, we'll just look at the daily on the VIX. Remember, we were looking at this falling wedge against bullish divergences, and I said that a break above was highly likely. Got that, and that coincided, with the downturns that we've been seeing here until last maybe couple days, counting today, and then we came back and we tested the top, the downtrend part of that wedge, and bounced off of that, and then came down, and here we are this morning, and now if we bounce off of that, we have a very distinct uptrend line right here. So it's kind of like I said with the hourly chart on the S&P. If we get, say, back down to this level here, still going to have, at least on the MACD, a bullish divergence on the VIX. So we'll see. Right now, the VIX obviously isn't giving us a sell signal. This could be pretty good support. So a bounce off of here on the VIX would coincide highly likely with a decline in the S&P. It doesn't have to be that way, by the way. You can actually have a rising index on some days with a rising VIX, but typically the correlation is negative. So folks, I will leave it there. Like I said, I didn't want to spend too much time on this morning. A lot more coming your way, likely today. If not, it'll be over the weekend. And then Monday morning's blog post will be important because, again, it will give you some of the details on our monthly scoring of what we call our Equity Market Conditions Index. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.